Thanks for coming out. And today's presentation is not a monologue about the different forms of venture capital, or capital, should I say. Today's presentation is from three gentlemen who are in the trenches, who, in Ryan's case, Dr. Ryan Fiorini was the founder of Immunologics. God, how quickly you forget. I'm thinking Intrexon already. That was acquired in a short 18 months or so by a company called Intrexon. And I tell folks, for the easy way to do this, I did this with the mayor, the easy way to do this is they own DNA.com. So you kind of give you an idea what they do. Dr. Gautam Gutnicker also has research technology out of MUSC and is in clinical trials and phase 2 trials. And so he'll talk about, and why I thought it was important to have him is how you can use federal funds to augment your capital raising strategy. And then most recently, Jonathan Alba is the president and CEO of Innocutus. I haven't seen him, I'm thinking Intrexon there, but Innocutus, and he'll talk about his company. They recently raised several $1 million, almost $7 million from Florida, from a company out in Florida. He'll talk about that. So I don't want to, for those of you who want to know the different forms of capital and capital available, there's SCRA's launch program, there's friends and family, that's on the website, on the Corda's website. Today, I think what I want to get out of this is, what does it take if you're going to raise capital? What happens when you get the capital? What are the requirements that people will put on you? And all of these things. So this is a more informal, there's no PowerPoint, none of that. There isn't any formal presentation by these guys that I'm aware of. So the key is just to go from them to present the story of how they got to where they got in Ryan's case of the exit and all the issues associated with that. Interestingly, all these three are in the life sciences space. So they're not on the digital or on the software side. They're all in life sciences. I think present a good example. So with that, I don't have any particular order, but maybe Ryan, you just want to start with the way you were and all the issues, and then we'll go from there. This is there's been at the last meeting, I guess there was a preference to just kind of hold questions for a little later, and I think we'll just have to wait and see. I don't know what you guys, if somebody's got one, just kind of make a note to ask the question. But I don't have any. I mean, I prefer that they be interactive, but I think Amy had mentioned the preference was to wait till the end. So thank you.
That sounds fine. So as Ernest mentioned, I'm Ryan Fiorini. I was a graduate of MUSC and then went to the Citadel's MBA program and knew I wanted to go into business. I started a company. I found a technology at MUSC, licensed it, and hired a CEO. Decided I was really going to kind of do this and start the company. Needed to go out and get money, and our process was a little different than the traditional biotech company. I didn't need millions and millions of dollars. We had a platform technology. So we were actually looking at, instead of going down the traditional route of saying, I'm going to make a product that treats wound healing or one specific thing, we said we're going to make antibodies. These antibodies are going to be against anything, any disease. We're going to make these antibodies against diseases that other companies want us to make them against, because we have a process that nobody else in the world can do. So that was one thing that kind of, to start the getting some money from people, was defining exactly what we could do and why the investor couldn't just go down the block and give their money to somebody else. When we decided how much we needed to raise, we then doubled it. I can tell everybody, just whatever you think you need to raise, double it, and it still won't be enough. We did something a little different. We did not take any money from any institutional type investors, no angel groups, no venture capitalists. The only thing that might be considered as a institutional type investor is SC Launch. They gave us a convertible debt, but that was really, everything else was just high net worth individuals. So what we did was we went out to some of these groups and introduced ourselves and gave them our kind of what we had, and we raised about $1.5 million this way. And with what I think is had the right team, the right technology, the right package that we gave them. We raised that in right around 6 to 8 weeks, and that was money in the bank, signed. A couple things that I've been talking to some other people about is kind of one of the things that somebody said to me was when I started giving this pitch about what our technology was, and the technology was really pretty complicated. It didn't really even make sense to me, and I was the one founding the company. And I had to explain it to people that didn't have a science background and had to understand what it meant. And I explained it to some people, and I heard back from them. They went, well, it just doesn't make sense. And I was thinking, well, heck with them if it doesn't make sense. Someone said, well, you know what? They're right because they've got the checkbook. And it was kind of humbling. And it was kind of like, well, they are right. I have to adapt to what I need to say to them instead of vice versa. And I know the talk that I gave day one was very different than the talk that I gave at the end of a couple months and even a couple years. It really changed. So I think that was the biggest thing for us was making sure that we just kind of listened to what they wanted. One of the downsides for giving money taking money from high net worth individuals is some of them are very needy, some of them are not, and thankfully, we were in the position of actually turning some people down. We actually interviewed every person, and there were some people we just said, I don't think this is going to be a good mix. And other ones, we basically said to them, we have to have you. Here's a seat on our board. That will happen. People will say, I'm going to give you $100,000 and I want a seat on your board. And you have to decide, do you want to give them a seat on your board? Technically, if there's enough of those, they could fire you. So it was definitely a balancing act. It was a lot of learning. I think the last thing that I just wanted to say was one of the other really very important things that I picked up was finding people that are smarter than you in the areas that you're not good at. And it was really very difficult for me to start a company, be the founder, be the only one with shares to a company, and suddenly step back and put somebody else in as a CEO and let them make the actual decisions. And there were times when he and the CFO, who were amazing at what they did, would make decisions. And at first I was thinking, well, heck with them. I'm not going to listen to that. I own the company. And then it was like, well, wait a minute. They own the company too, and I hired them for a reason. And that was really hard, but it was absolutely the smartest thing I ever did. As Ernest said, the company sold it's an undisclosed amount, but all of our investors are very, very happy. It was about 18 months, and those investors, keeping them happy over the 18 months, most of them were really pretty easy. There were very few that gave us any trouble. That was kind of the CEO's duty, was to keep our investors happy. My duty was to move the technology along. Our CFO was to keep the financials looking good. I think if I can add one more thing, that was the other big thing that we found after we sold the company. The company that bought us said that our financials looked better than any other company they've ever purchased. They purchased 15 companies last year, us being the smallest, and we had the best looking financials. And I would have thought, we can just use QuickBooks and, it's easy. The financials were so important. We laid those in front of them, and literally within hours, they came back and said, we'll take it. And, you fight us too much on the price. And so it was really important to find those parts of companies that you may think, well, I don't need to put as much effort into this or that. When somebody's giving you $1.5 million, they want to see where their money's at. And at the drop of a hat, they want to say, I want to see every dime you've spent, and I want to see it right now. And we had the ability to say, here's a login, go into the reports of QuickBooks or the program we used, and you can see every dime we spent down to the the little tip on the end of our pipettes that we used, anything that we used, you were able to see that cost, a penny. You could see how many we used. And you think, well, that's impossible to do. It's really not. If you set it up well in the beginning, it's not, and it made a big difference at the end. That's it.
Appreciate what they got themselves. I guess, Ryan, just my observation, I guess. What's really nice to hear is how accountable you felt to your investors. There are many people who start things who don't feel that way. So that's it's refreshing to have financials down to the tips on your pipettes. That's remarkable, and just makes for a clean transaction and not a lot of angst among the investors.
Yeah, I mean, I guess I would say if you don't, you can probably do it one time. You'll never do it again. The nicest thing that I think I ever heard was when we started calling our investors and saying, hey, we've sold the company, here's how much you'll be getting. And I would say probably half of them said, tell me what the next thing is. I don't even care what the technology is, just tell me where you want my money now. And had we not kept them happy during that, I don't know that a lot of them would have said that. And it was really, it was really pretty humbling to hear that from people. And so I think that was keeping them happy. Certainly there's some that wanted some things and you just have to tell them, I can't do that right now. But for the most part, keeping them happy and keeping them informed was pretty important.
Ryan, first string's looking, so send him my way.
I have 2 questions for you. You're open for questions.
Or do you want to wait till the end? Or?
That's right.
Okay.
Okay, so you had said that you had a CEO who was doing the investor management, and you had a CFO who was handling the numbers. What was your actual title?
I was the chief operating officer. So my role was, we had a scientific technology that was very early stage. And so my job was to move that along to a point that made sense scientifically. So some of my time was managing the science that was occurring in the lab. We had scientists actually doing the work in the lab, but to sort of make sure that the projects that were being done were done in the right order. And then also all the business development was landed on my shoulders.
And then what accounting program? You had mentioned QuickBooks, but then it appeared that you didn't use QuickBooks. Did you develop a program, or?
I'd have to get the name of it, to be honest. Yeah, it was like a QuickBooks, some online type thing. I'll find what that is for you. Let you know. Yes.
How did you attract that CEO and CFO talent to your organization? Was that pre your 1.5 million, or was that, did they help you get that, or
Yeah.
what's the art of finding that talent when you are strapped for cash?
That's a really good question. So both of the people that I got were retired, had done very well for themselves prior to coming to work with us. The CEO that I hired, I knew from, he was my mentor at the MBA program at the Citadel. The MBA program pushes this mentors program, and I decided to try it and met him, and we kind of hit it off. And a year later, he finally got sick of hearing about all the CEOs that I was interviewing and didn't like, and finally said, you know what, I'll just do it. And he got into it, agreed not to take any money ahead of time. That was another really important thing, was our investors want to fund the things that are important. They don't want to fund a CEO's salary in the beginning. And he and the CFO were in a position that they could defer salary until we had a contract. It's totally fine with them. That made a big difference when you're trying to raise money. So that's how I found them. They were the reason that we probably raised more than half of the money, was just kind of in their network of friends, and you kind of get the tree going, and the phone tree going, and next thing you know, it kind of just spreads out to, we had 28 to 30 investors.
Did you give them an equity stake, a large equity stake?
I gave them I don't know if they consider it large. I consider it large. Yeah. I think they consider it large, yeah.
Okay.
So our investors took about a third of the company.
How did you, 28 investors, a lot of people communicate. What was your cadence to communicate to those people and keep them comfortable, if you will?
So we did, I guess I'll just explain it. We did one major thing, which was we got the information out to them before they wanted to hear it. What we did was our website, we had a back end of our website built. It's a little secure portal that our clients would go into to see how their project was progressing along. And actually we modeled it after, if anybody's ordered Domino's online, you go online and there's this little bar that goes across and says, Jim is making your pizza and Bob just put it in the oven. And we kind of did the same thing, but for making these antibodies. So, a customer in Belgium can log on at what would be 2 a.m. here and see that their antibody is making it along. We then just took another section of that and made one for our investors. And in there were up-to-date financials. It was supposed to be a monthly letter from our CEO, but it turned out to be semi-monthly. And kind of had just getting that information out to them before they want to hear it. There were many people on there that we thought were going to be the most difficult investors. And you could see when they had logged on, and some of them never logged on to that system. There were some that handed us a check day one, and I never heard from again until we handed them a check back, ever, not once. Our minimum was $20,000, so that was the minimum we took. There were very few of those, actually.
What kind of questions did you ask when you said you interviewed those folks? What kind of questions did you ask, or what things did you look for in order to find folks that weren't too needy?
Yeah. So we wanted it. I don't know that there was like a set list of questions, but we just kind of felt them out to see were we on the same ballpark. Were they looking for the same thing that we planned to get out of this company? We had a 5 to 7 year window. We thought we would get this X money back to them. Obviously, 18 months, no one was mad at us, but if somebody came back to me, we're talking 5 to 7 year turnaround, someone says, well, I like to know, I like to get my money back after a year, or, it'd be like, we're never going to be able to do that. We didn't think we'd be able to do that. So just making sure expectations were managed, and if they had the same expectations we had. There were some people that we thought would just be a little too needy. I think they just need a little more hand-holding, and I think they'd be great for a smaller company that had 3 or 4 investors. 28, you just couldn't do it. All of them were pretty local, so the furthest we went was Charlotte, with a few outliers that don't really count because they were the CEO's friends that were up in Philadelphia and things like that. But for the most part, people we didn't know were all in Charleston or South Carolina and Southern North Carolina kind of thing. But yeah, I think just kind of making sure expectations are met and kind of are on the same page. Here's what we plan to do. Does this fit for you? And it's pretty clear. It's really hard when you look at your coffers and you see they're empty, and to say, I'm not going to take your $100,000. It was the best thing we ever did. We were meeting with a couple of the angel groups, and one of them, we just didn't hit it off very well. We just didn't see eye to eye on the questions and the answers. Another one, we really did. We planned on taking money from them, and then it just hit a point where we just didn't feel that it was right, and it would have been about half of our money. And we said, I'm sorry, and we had already actually raised it, and we had to tell them no, and that was very hard. It was very hard because I don't know now if I ever went back to them if I could get it, but same token, it was, in retrospect, it was the right thing to do.
Name is Jonathan Alva. I'm the Chief Operating Officer in Acutus. We've been around for about 7 years from our origin. We started off as JSJ Pharmaceuticals originally. And we did start off with some angel investors. We got a couple $1 million out of an individual who happened to be in our industry. We're in the pharmaceutical industry and dermatology. And that worked out quite well for us initially. It got us off the ground, let us build our organization. It didn't take too much out of our ownership to do so. And I think one of the things that's important to me anyways when I was looking for funding is that I don't give up my soul, meaning who I am, and my ownership early on, because you can't ever get that ownership back in your organization. Years ago, I was on Wall Street meeting with some folks. This is before we ever started the company, and I was meeting with an analyst in our pharmaceutical business, and a guy he was in his office, and he picked up a piece of paper. He says, "Never be this person." So, well, who's that person? He said, "This guy started his own pharmaceutical company. He's based over in New Jersey, and he started off with a pretty good chunk of money. But just little by little, people kept coming in and investing and investing." He said he owns 0.2% of his own company. He said, you never want to be that person. So one thing that I've always been is very jealous of my ownership. And you'll get even employees who work for you for a period of time, and after so many years, they feel like they deserve ownership in your company. And while I appreciate their work, I pay them a salary. They've never mortgaged their home like I have. And so, one thing I do tell to people is be jealous of your ownership, because you can never get that piece back. We were fortunate in the gentleman that we had come into the company and get us off the ground to build our infrastructure and our sales organization, and we started growing the company, and it went well for us. At a certain point in time, we had been approached to be acquired. And we went through the whole song and dance with them. Ultimately ended up that they couldn't get the financing to buy us. But the one thing that I think is really important in the process, because it was very similar to raising money when you're going through the diligence in the process, is that you have to have a good team in place around you and a good support network. Because if you're trying to run your day-to-day operations in your company, and you're also trying to meet with these acquirers who are also trying to raise the money to make the deal happen, it's spreading you pretty thin. You lose focus of the business that you're trying to drive on a day-to-day basis. And if you lose focus on that, you've lost focus on everything. So it's really important that you have a good partners around you, good teammates around you, whether it's a financial partner, staff around you. And everybody knows what they're doing when you're going through the process, whether it's the sale process or the fundraising process, that you can all stay focused on what you need to be doing individually. Ultimately, we either needed to be acquired with an infusion of money to take our company to the next level, or we had to go find institutional funding. We started that process. It probably took the better part of a year for us from starting to look to closing the transaction. I'd say that's a pretty good timeline for most. A lot of people will come along and tell you, "Oh, we can close this in 90 days." It's an absolute lie. They just cannot do it. And you also find that as you start to go out there and look, you get competing interest. You'll have a lot of these people who are brokers, so to speak. They come and they say, "I've got connections at all the people on Wall Street. I have this fund," and so forth. You really need to know who you're talking to. You really need to dig into their background. You need to look at their references. You need to talk to people they've actually funded before. Because it's really easy to say that I was part of something, but did you really do it, or were you just part of it? And what they're really looking for is to sign you up to be an exclusive with them. And they know they've gotten you locked in. It's like finding a realtor to sell your house. They sign you up, you're locked into them. Even if they don't do anything for you, the house sell, they still get their commission. And these people look at it the same way, I think. And so you have a lot of competing interests to try to get you to lock in with them, and they don't necessarily have the relationships and the ability to pull the money in. And as we joke internally at our company, we had a legitimate private equity company interested in us. We had been on the Inc. magazine list, so we had a lot of different interested parties looking at us, and we had a really good group looking at us, pursuing us over a period of time. We also had this other group that was interested in funding us, and they absolutely had the money. It was locked up. They had this guy, Vinny. I kid you not. Vinny was this mysterious businessman from Connecticut who was huge money. And he was going to come in with great terms for us. but Vinny never materialized. We wasted a lot of time on Vinny. And I watch other people in business that have their Vinnies that are coming. Yeah, they're coming. Just sign on with us, stick with it. In fact, Vinny didn't exist. He did exist, but he didn't have money for us. And so you've got to make sure that the people that are trying to be the brokers to you really do have those relationships and really do have the resources before you sign anything up. You know, they're going to make a lot of money off of you. Make sure that they're going to earn their money, that they can come through for you. Because if you lock in with them, you lose your ability to go to other legitimate people. Ultimately, after wasting a lot of time on Vinny, we went with a private equity group out of Tampa called Ballast Point Ventures. Ballast Point focuses on businesses in the Southeast. In fact, they're looking for opportunities in Charleston right now if you have a business that you were looking for funding for. I have nothing but great things to say about Ballast Point. They've been a wonderful experience. When you're going through the process of engaging them and getting your funding, it's you know, a lot of emotions run through the process. You get engaged with them, you start talking about valuations of your business, and like every homeowner, you always think your home is worth more. You do the same thing with your business. And so there's that emotional standpoint there of coming up with the valuation process. As both these gentlemen said, having your finances down, cold inside and out. You have to know every number. You have to be prepared to speak to it instantly without having to go back and take a couple days to figure it out. You need to know your business inside and out on the financial side and have it down cold. We went through the process with them, coming up with valuation, and then I will tell you, you can't take this stuff personally as you're going through the process, because there's going to be moments, again, where you think that the valuation is, you know, they're trying to take advantage of you. You come to where you feel is good, and then we'll call it the October surprise comes. As you're getting close, you've engaged them, you're locked in with them, you're going to the close. The close is now 60 days out, and we're going to start working with the lawyers and all that. You get the phone call back that says, well, we've been looking at the valuation. It isn't quite what we thought. You ask them, well, why? Well, there's these following reasons it doesn't quite fit. They are trying to get a better deal out of you. It's their job. It's not a personal thing. It's their job to get the best deal for their investors that they can, to get the best valuation. And they'll get you to an emotional standpoint where you're locked in and you believe it's all done deal. We're just riding home with the lawyers to get to the close, to build the business again to the next level. And they are going to come back at you again, and they are going to try to get more out of you. Don't take it personally. Don't get upset about it. Just be rational and work your way through the process. Hold your ground. Look for the places that you can give a little, but that they can feel comfortable with getting a little as well. And ultimately, you'll get to the deal. I can tell you that in our process, it almost fell apart. My business partner was so angry and put out about what was going on that he was ready to walk away from the deal. And ultimately, we were able to become rational and work our way through it. And I really do believe it's just part of the process that they go through to get the best valuation for the company. I will tell you, be prepared to spend a lot of money on lawyers. We raised $6.5 million, and the lawyers cost us $250,000. And I'm telling you that we did not spend. We weren't wasting time with them. It was pretty intense. 2 different law firms. You get on the phone call with yourself and 6 other attorneys, and you start doing the math at $450 an hour. It's expensive hour, and you just don't want to talk about the golf game when you're on that call. Let's put it that way.
$450 is cheap.
Well, I'll give you some referrals. So the process of going through the legal process it's difficult. There's a lot of documents to read. Try in advance to know what you're getting into and understand the process, so you're not learning on the fly. And then going forward, we closed our deal in April, and we have continued to have a great relationship with the folks on our that had invested us at Ballast Point. Setting up the board has been good for us. We have a 5-person board. They take 2 seats on our board. My business partner and I have the other 2 seats. And then we have a spot for an independent, of which we pick. I know that the investors will always like to bring great recommendations of individuals with good experience to your attention that would be a great fit. But also remember that that person and their fit may oftentimes have the same point of view that they have. So if you ever get into a sticky situation, and sticky situations always will happen, you want to make sure that it's an independent board member that you have selected that will look at your best interest as you move forward. You don't want to get into the situation where you find that you're the two and they have the three on the board in our case. I guess, as we've moved forward, it's been a little bit of a different dynamic for us in that it was two gentlemen. We had complete control of the company. We had an angel investor who we talked to twice a year maybe. He was good that way. We now, as we say, we have a boss. The board is our boss. And I don't necessarily look at the investors as our boss. It's the board as a whole. We do come to decisions together, but we do have a boss. It means that reporting of financials has to be extremely timely. They have to be accurate. We've spent a lot of time and effort beefing up our financials on a monthly basis so that they're more robust, easier to read, have more detail for the board. And that means running everything by the board. When you get into contracts and so forth, getting their input so that you don't get back to a board meeting and there's a surprise that you've signed some deal with somebody and they didn't know about it and now you're explaining yourself. So if you start things, communication on the front side, have an open dialogue on a regular basis with the board members, you're going to be a lot better off in the long run. And ultimately, like I said, it's been a great experience. They've brought a lot to the table. Again, I feel fortunate with the people we have. They said, I think at our second board meeting, they said, you know what? We have a game plan. You laid out this game plan, and there are some investors who say you better live with your game plan and die with your game plan, and and don't let it crash. But our board has been good in that they've said we understand the dynamics in the business place change, and we have to be willing to change with the dynamics. If we're so strong-headed to stick with the game plan and don't change with the dynamics changing, you find yourself running into a brick wall sometimes. So they've been very good to us that way. It said that as we need to make changes, let's talk about it, figure out where we go. We don't want to be strong-headed going in a direction that's not going to work for us. So we've been very fortunate they've had that open-minded perspective to the direction that we're going with the company. So I think that covers it.
Thanks. We'll take questions here. Our panelists is very, very insightful. Raised, you just get me kind of thinking about a couple of things, about some observations. Typically, when you're in capital raising mode, you always, I've seen folks who think that the other side's always right, or the other side has the right to bark more than you do. I think John and all of you guys have pointed on the very, you really have to vet who's on the other side of the table very, very carefully. I have seen in my role at the court, I have seen no shortage of people who've come in from out of town, claimed all the stuff they've been doing everywhere else in the country, and now that they're here to help. And when you peel the layers of the onion back, some of us have seen this firsthand. Jonathan Gautam probably more. I think yours moved pretty quick. You just have to be very careful. So you really need to vet these folks extremely carefully. Number one. Number two, I couldn't agree more with this point of locking you up. They want to lock you up so you can't talk to anybody else. Don't do it. You just don't need to do that in this environment. And then there's some who want fees on top of that while they're helping you about getting things buttoned up. So they just want to keep squeezing. So the takeaway is, you really have people here. These three guys represent 3 of 6, 8, 10 people who've done it. So the key is really don't feel like you're out on your own. Pick up the phone. Jonathan's always accessible. Gautam's right here. Ryan, is happy to tell you what to do, what not to do. Each situation is absolutely unique. The other thing that's very, very important, Matt Rice with Ballast Point Ventures has said to me, I don't care if you're, if you need capital 2 years out. I'd like to develop a relationship with you today. So it's very important for you guys who are moving along, who might think you need it, to develop and get some feedback. We already have some, so Jonathan's here able to vet them and vouch for them, which is huge in my opinion. You don't need to do 30% of that work already instead of focusing on things.
And Ernest, I would even add to that, the whole vetting people. We interviewed people that they had done business with we asked them for a list of references, just like they ask us for a whole spreadsheet of references. We asked them for people, CEOs of companies, and we interviewed them. And asking those questions was very, very valuable, understanding it. And if you can find people who are on the board of other companies that they maybe have closed out the transaction with previously, that's very helpful. I mean, they don't even know this, but we found a CEO of a company that they had sold previously, and we went to him. So we had a completely different perspective. It wasn't even a reference they gave us. But if you can do your diligence and vet them that way, it was very, very insightful for us.
The second thing, and very important, I'm pleased to see
Derek.
with Derek? Darren. So Darren is here from the College of Charleston. You know, he's in the entrepreneurship program. And somebody had told him, he didn't know all this goes on, so when he found out from Dr. Shaver, he came over here, and, you know, he thinks that he'd want to start a company. You know, we just got through Brendan Kearney, who wrote a story on Fipio, a young gentleman we first met, you know, for the Honors Program. But here's the point of commonality, very, very important point. Ryan met his CEO at the Citadel in a mentorship program. Fipio's founder met his mentor was the guy who started Blue Rhino Gas. That's global distribution. So I've been trying to figure out what is the connection between the academic institutions and the digital quarter, so it's fruitful. By listening to this today, and by Darren being here, and by Blue Rhino, all that's happened in 1 week, I now have the partnership. Talking to John about some things that they'd like to do. So the point is, I guess it's very important to be engaged, because if you're engaged, you know what's going on. Otherwise, you're toiling in the trenches trying to figure out how the hell am I going to do this. It seems insurmountable. The reality is you don't have to do it yourself. You just have to go, and I underscore this: go where you can get value. Don't just go to something and waste your time. Time's important to all these guys. I'm not going to send somebody to Ryan if I think they haven't passed the sniff test. I mean, it's just not going to happen. So, and you know, the guy from Fipio is a great example. The second thing I thought was very interesting was people. I mean, ultimately, these guys are buying people. The idea is great and everything else, but you've got to size up the individual, because I can tell you firsthand, you know, that there's a lot of money that I was involved with that went into a company, and the CEO turned out to be a total flake, and he's absolutely the polar opposite of what these guys say, which is control, reports. He thinks that he can do whatever he wants. He just came back from a trade show and goes and rents a Lexus into a regular car, while the company is basically hasn't had its payables. So you have both extremes, and I think for you guys, this is not a theoretical exercise. These guys are here to tell you what to do and what not to do, and help along the way. So that I just don't know what questions anybody might have.
You know, one curious thing is that, you know, it's nice to, you know that, you know, and hope that you won't make any mistakes, but you will. And and I made them about 3 or 4 times. So it's just inevitable. The idea is that you survive the attrition. So just stay in the game and keep going, and, you know, I think good things will come by. But you know, for example, there was one guy, and you know, who said to me, "Oh, I'm this big biotech experience, 10 years in this, you know, really big pharma company and all that," and I was very impressed. And turned out he was a facilities manager at this company, but, you know, he left that out, acting like, you know, he's a big pharma executive and this and that and the other. So you just never know who you're going to get. And this town, because you don't have a critical mass of life science companies and biotechs, it's more rampant. And people come in and they're like, "Oh, I worked at J&J. What'd you do at J&J?" You know, I never asked those questions. So. And you suffer. I think it's important.
If I can mention one more thing. So, you know, this time in our lives, you know, you're looking at 2010, 2009, looking at raising a lot of money when people are saying, well, the economy's horrible. I don't disagree. In 2005, you could start a company that said, well, we're going to take these cups and we're going to draw a smiley face on them, and you could probably get a couple $1,000,000 for that. Now, the money is still there. You just have to have a good technology, a good company behind you, a good business plan. And what I found was, like I was saying, you really have to adapt. You have to be able to sort of just eat the humble pie and say, you know what, if I got to change this. And the money is absolutely out there. If you go and you talk to these people and the money's not there, or you get shot down immediately, look within and think to yourself, well, for some reason, they're all shooting me down. Maybe the idea is not as good as you thought. Maybe the management's not right. Maybe it's one of these positions where you're not right for the position you're in. Like I wasn't. I was not right for the CEO position of this company. As Gautam said, the people that were going to give me a check for $200,000 didn't want to look at me. They wanted to look at a guy with gray hair that had done this before. And they knew me, they trusted me, but not with $200,000 of their money. So, that was just, you may not be right for the right position. There's nothing to say that you can't own more stake in your company and be a position that's down lower. And that was really important, but definitely look within and realize that if you keep getting shot down, there's probably a reason. And it's tough, but it was by far the smartest thing. And Gautam's right. I made more mistakes. From if I was to do it over again, I know I would do half the things different. But it was successful, and I learned more. With multiple graduate degrees, I learned more in the few months that it took to close this deal than I learned in any of those graduate degrees. In my whole MBA, I learned more in those 60 days. And I mean, it's just because you're getting exactly how it really works, and you're hearing about, tax implications and how do you actually close a deal. I think you close a deal, they give you money and it's done. Well, that's not really how it works. There's the lawyers and how it all, it's really, really complicated. So just be willing just to step back and say, I'm just going to learn from this and I'm going to let somebody else run this, or I think this is where I fit and somebody else can fit all the other areas.
My first question has to do with board of directors. John talked about how some advice on selection, composition. Could you two maybe address any suggestions? And the second thing is, for all three of you, did you have a separate formal board of advisors from the board of directors, that either from a technology perspective or business perspective?
So in my case, both. We have a scientific advisory board, and those are industry experts, scientific experts who help with the business and the strategic planning. And then the board of directors, in my case anyway, is most of them are made up of investors. And that was a compromise we made because we needed the money at certain points. And so they want a board seat, they get a board seat. But always I've tried to maintain at least one independent director, because the main focus of when you have a board full of investors is dilution. And for a company in this business, in life sciences business, you need a lot of money to go forward. And so you cannot be worried about dilution all the time. But it's also important that when you start forming the board and these relationships, to realize that, once you start getting more and more money, without revenue, I mean, in our case, there's no revenue, real revenue. So you start to lose control in terms of owning less and less of that company. So it's important to have contracts in place and agreements in place, sort of with poison pills that protect you to a certain degree. Can't go crazy, but that will help you. But it's always important to maintain a relationship with those board members.
We also had a scientific advisory board that I put in place, myself and my CEO. Industry advisors, there's some physicians, some PhDs. Board of directors was made up of 7 people. 3 of them were the management, myself, the CEO and the CFO. 2 of the positions were investors, and then the other 2 were people that we placed, that the whole board, including the investors, agreed to those positions. Exactly what Jonathan said, it was very important to know where that swing vote is, and the more you can bring that swing vote onto your side, the better, because when, for example, we wanted to sell the company and there was an investor that said, well, I wanted my money to sit there for 5 to 7 years, and if he could have got the other investor on his side, I want to sell the company, I want to get out, can't get out if the board says no. So having that, if it's just a sham board, if it's the straw man, then you're not going to get anything out of it. But we're able to really have a board that, there was times when the board of directors would bring up things and I would just bang my head against the wall thinking they're just making this difficult. And then you look back on it and you go, that was a really good point they brought up.
We didn't have a formal, a scientific advisory board. We did have a series of consultants within our business and our industry that we utilized prior to the transaction with Ballast Point. At this point, we actually are in the process of forming a ongoing scientific advisory board that we're going to be utilizing. And I think that's the question.
I think from an investment perspective, though, very important, who you pick on the board, and Ryan, you could probably speak to this, can add value to the bottom line of the company's value. So, for example, ATD, Automated Trading Desk, that was sold to Citibank, had on their board the immediate past president of the NASDAQ. His connections, his Rolodex are just unbelievable. So you can actually, if you put people on the board who can align with the next investor, the next purchaser, the purchaser. And that was the one thing I was going to ask you, Ryan, is how did Intrexon get into the mix? Did they make the approach? Or because by virtue of the fact that you were in the industry, did somebody, I'm just curious, when you start to exit this, to my thinking, you've got to start aligning with where you want to, who you think would be a potential buyer, not just doing the most wonderful things and paying salaries. There is an exit. That's the way you know you're investing. How did that happen?
Yeah, well, I can't talk very much about how any of that happened, but we were not soliciting ourselves to sell. We were approached by Intrexon and kind of then had to put it in front of the board and decide to get out. It's something that has to go through the board's approval, and then the way our bylaws were written, it then has to go to the shareholders. And technically, I can't remember if it was like 70% or 75%. We had to have 75% okay by our shareholders to agree to sell the company. Where I'm sitting here going, oh yeah, we're selling. And I had to get the okay of all these other, board and shareholders, some of which were board and shareholders, and before you can sell. So it's a tough process, and I think I agree with what Jonathan's saying. Normally it takes a long time. When Intrexon approached us, they said we will be done in 60 days from the day they met us, and we were done in 68 days, which was
Almost never happens.
I would say it never happens. We were floored when it actually did happen. 68 days later, and the money was wired. And but during that time, one of the things that Ernest was saying is, we had to agree that we wouldn't do certain pieces of business during that time. Imagine if you own a grocery store and someone says, I want to buy the grocery store from you, but for the next 60 days, you can't sell a single thing. Nobody can come into the store for 60 days. That's great if you see what they're going to buy it for. But what happens on day 59 if they go, you know what, we don't want this? For 60 days, you haven't had any revenue, not a dime. That's scary. But as both these guys have said, you just have to weigh. You have to weigh it. You have to renegotiate with them. Say, well, you know what? I'm not going to do that. I'm not going to sell produce, but I'm going to sell everything else. Or I'm not going to bring any new customers in. I'm just going to keep my existing customers. You can push back. And one of the things we did with our angel investors that we were talking to is one of the groups that, like I was saying, we just didn't align with. I think it was because we put down some terms and we said, these are the terms. And they said, well, that's not how we work. We put the terms down. I said, well, then, it was nice knowing you. These are the terms. These are the ones we've already sold shares at, and this is how it's going to go. And to turn somebody down is tough, but it's important. We considered turning down Intrexon to sell the company. We decided to do it, and it was, in retrospect, I think the best move we could have made for the state, for the city, for my investors. But pushing back is important.
One key aspect is that when you're selecting your board, it's an evolving process. So 5 years ago, I wanted this all-star board member. I went to him and I said, could you be serving on the first string board? And just simply said no. Who are you? So, but now down the line, we're able to attract sort of big executives, pharma executives on the board to serve on the board. So it's an evolving process, and you just got to keep at it. So one of the hardest thing I've had to do is restructuring the board, and as part of that, I actually had to ask my co-founder and my ex-boss at MUSC to step down from the board, and that was a very painful process. But that's part of the deal, I guess.
And when people are approaching you with any type of capital investment, did any of you guys in your ventures require a due diligence fee from any of these PE or angels or VCs?
Not us.
Due diligence fee.
Right, so if they want to come by you, hey, we'll give you 30 days or 60 days for $100,000 of your money. No.
Yeah, I would, that's
That's a
one
bad
of the-
idea.
That's a really bad idea.
You just don't want to do that.
Yeah, just tell them.
No, they pay you for.
Oh,
60
they pay you?
Yeah. They pay
Always,
you.
yeah, that's a great idea.
Unless, if.
Well, yes and no, I mean, provided they're not getting too much of the intellectual.
Well, I know, but I mean,
See,
you
in
know,
a case like Ryan's, I would think that would be very appropriate if they put stipulations of what he could or could not
Right,
do.
right,
Then
absolutely.
you need to have a penalty at the back end of the deal if you don't go through with the transaction.
Right.
You have to make me whole. And I think in in that situation, it sounds like it'd be very appropriate. In a lot of situations, I don't know if it would be.
We may or may not have had exactly that.
Thank you.
How does it work when you start a business off of licensing another technology?
how,
Sucks.
yeah. Well, it depends who you're licensing from, you see.
Is that a present or past tense?
I don't know, it remains to be seen.
It's
Does
really-
the license holder require equity and?
You have to negotiate. I mean, it sort of spans the gamut. So they may take equity, they have a royalty based on sales, they have upfront fees and, all kinds of stuff. So you have to just get in there and negotiate based on what you can do and the resources you have available. Everything is negotiable.
I think in their case, I know, John, you asked the question, their case is a little different because they're negotiating the license from the university, maybe I say so. It's a process that I'm intimately familiar with the guys, and it was painful. I think that they were
Quite.
tested on the way in and to you.
Yeah. But I think in any of those situations, if you have to license something, what Jonathan said about how much they spent on their lawyers, we spent about the same amount in 60 days to sell a company. So but I would have paid them twice that because they made sure that everything was perfect, including the license. I mean, making sure that someone's not going to come back to you in 10 years and go, you actually didn't have a valid license for this. And we're going to sue you for everything you've got. And so making sure that things are in place. But, a license is really just kind of a piece of paper that says we're not going to sue you, especially if it's a patent application. There's nothing there. So it's something that's saying down the line. So yeah, licensing is important because then you have something and you can value that. If you just have a company and has no assets, then what's the value? But if you have a patent application or something that you license, it can be worth more.
Last question.
I have a question for you, Jonathan. So what you said you were very jealously guarding your equity stake, so you go very early on. What did you bring to the table? How far did you push it before, as far as getting your first deal or having things you could kind of negotiate with in the angel stage?
In the angel stage, well, we were fortunate that my business partner and there was another business that we spun this out of. And we had been able to start the company using overhead resources of the other existing services company. So that it helped us get off the ground, so we had revenue. We weren't at that time going to angel money with zero revenue. So we had revenue coming in. It's something to show for what we had. And so that helped us out in those early stages. And then, from there, you just have to negotiate and work your way. We're fortunate again with Ballast Point. One of their things is they say they never want to be a majority shareholder in the company. They really believe that management has to have a stake in the business, which is important. Because if you don't have a stake in the business, what happens when times get tough? You're going to run away. They want, at least at Ballast Point, they want somebody who's not going to run away. So that kind of helped us a little bit, but still, you know, you can get pretty close to that 50% line of ownership there, and that's where, you know, you pick your battles.
Well, I really appreciate you guys coming on. This was very insightful, and, you know, as I tell everybody here, you know, these are folks in our community, you know, so if questions need to be asked, they can be reached, you know, but thank you all for taking time from your schedules this morning to do this and educating us. Much appreciated.